I've used mutual fund and ETF a lot throughout my financial independence journey. That's why I was able to be financially independent and retired at the age of 41. Let's compare the benefit and risk of ETFs and mutual fund. We'll do the comparison based on all these parameters today. We will compare what are the underlying assets, what is the origin of these funds, how do you trade these funds, how the price is allocated, what are the fees, is there any minimum requirement, and how is the transparency. Let's dive in. ETF, as the name suggests, it is exchange traded fund. That means a fund which is traded on an exchange. So what is a fund? So consider this candy jar as an ETF. This is a fund. And what does it have? It has a stock of Tesla. It has a stock of Google. It has a stock of Microsoft. ETFs is a basket of stocks, or you can call it ETF is a jar full of different kind of candies. And each candy represent a unique company. And this entire ETF can be traded. Now, usually what trades on an exchange? It is the stocks of Tesla, Google, Microsoft, MicroStrategy. These are traded. Traded means you can buy it at 11 o'clock, sell it at 3 o'clock. That is called trading. When you can trade this entire fund on an exchange, it is called exchange traded funds. Now, what is the difference in mutual fund and ETF? The same jar is mutual fund as well, and it has the same set of companies. The only big difference is now you cannot trade this fund on the market. What does that mean? That means you cannot buy and sell this mutual fund on the same day. And the third one is index fund. Index fund is a mutual fund. It is a type of a mutual fund. It just mirrors the index. Either it could be the Nasdaq, Dow Jones, S&P 500. That's all it does. And now there are various types of mutual funds like growth stock mutual fund, large cap, mid cap, small cap. For example, large cap, the main objective of that mutual fund is stability with moderate growth. In growth stock mutual funds, the earnings are usually invested back in the mutual fund rather than distributing as a dividend. So in mutual funds, a fund manager will select which companies to pick, which companies to eliminate. He will try to maximize the gains of his mutual fund against the index. So it requires more effort compared to the ETF or index fund. That's why mutual funds are more diverse. There are around 7,000 mutual funds in the US. Every index fund is a mutual fund, but not every mutual fund is an index fund. And mutual fund managers will deploy different strategies to beat the market. While on the other hand, in ETFs, the fund manager doesn't have the liberty to pick and choose what stock will go in the ETF. It usually tracks the index or predefined basket of assets. For example, VFIX, it tracks the S&P 500 index. VT-SAX, it covers the entire US stock market. So what do I mean by ETF just tracks the index? If S&P 500 consists of 7% of Microsoft stocks, the fund manager will just match exactly that 7%. In next quarter, Nvidia is not performing well, and if it is thrown out of S&P 500, the fund manager will just copy that. The index tracking and rebalancing is pretty much automated in the ETFs. And there are all sort of varieties of ETFs. For example, XBI, it is a biotechnology ETF which tracks that biotechnology index. If you think solar energy is the way to go forward, you can invest in this TAN, solar energy ETF. The fund manager of the ETF doesn't have the liberty to change the proportion of which stock will go in the ETF. It is predefined and it goes by the index. So mutual fund has more diversity, ETFs has comparatively less diversity, and same thing for index fund because it just tracks the indexes. Let's come to the origins. The OG is mutual fund. The first mutual fund was MIT, Massachusetts Investor Trust. It was established in the year 1924. The first ETF was created in the year 1993, SPY. It is Spider S&P 500, which tracks the S&P 500. Now, as you know, in mutual fund, it is an actively traded fund. So the fund manager plays a vital role in the success of the mutual fund, where they can rebalance or mix and match whichever way they want in the mutual fund. So due to this, the fees is little higher in mutual fund, and it kept rising after 1924. Jack Bogle in 1974 observed that the active management often leads to subpar results due to high fees and inconsistent performances. So he came up with this new fund called index fund, which were passively managed mutual fund, and they called it index fund because they were just mirroring the indexes. The first index fund was Vanguard 500 index fund, which mirrored the S&P 500 index. Now let's compare the trading. ETFs are traded live on the market. It is all done real time. For mutual fund and index fund, no, you cannot trade it. So what does that mean? If you try to buy a mutual fund or index fund at 11 o'clock or 3 o'clock, you won't be assigned the units right away. You will be assigned the units by end of the market. So by end of the market, you will be assigned the units based on the NAV. NAV means net asset value. And for ETF, it is done real time. And the next one is fees, or it is also called expense ratio. This is one of the vital components which you should consider before buying any fund. If you compare fees of ETFs and index fund, they are pretty comparable. They are both low since both are tracking some sort of indexes. Now let's compare VOO. VOO is Vanguard's S&P 500 tracker ETF. The fees is 0.03%, while for the index fund VFIAX, the fees is 0.04%. Now take the second one, SCHB. It is Schwab's US Broad Market Fund. If you compare that with the index fund SWTSX, it is again Schwab's index fund for US Broad Market. The fees is same, 0.03%. So what is 0.03%? That means if you are investing $100, you are paying 3 cents to the fund manager before he start investing for you. If the fees is 1% of the fund, that means you are giving $1 to the fund manager as the fees, and then he will invest $99 in the actual fund. Let's compare ETFs with mutual funds. Let's compare IWM with... So IWM, this is an ETF which is Russell 2000, which tracks the small caps. The fees for this fund is 0.19%. Similar mutual fund, PRSDX, it is also a small cap mutual fund, but this mutual fund is trying to beat the IWM ETF. And that's why, since it is trying to beat it, the fund manager has to work harder to beat the index, because small caps are less liquid, they are high volatile. It requires more research and more close monitoring. So the fees is higher. That's why the fees is 0.93 for the mutual fund. If you compare the fourth one, VTI, and FCNTX, similar thing. It is total stock market exchange fund and mutual fund. The fees are 0.03% and 0.85%. For the similar reasons, since it is actively managed mutual fund, the fees is pretty high compared to the VTI. Now, as you know, ETFs is usually it's a passive fund, but there are 5 to 10% of the ETFs which are actively managed, and one of the example of that is ARK Invest. ARKK. So ARK Invest is led by Cathie Woods. It focuses on disruptive innovations like fintech, cryptocurrency, robotics. It invests in these type of technologies for maximum returns. These are actively managed ETFs with high expense ratios. Now, if you want to invest in any of this, let's find out if there are any minimum investment requirement. For ETFs, you can buy 1 unit of the ETF, and that's what was happening till now. But now there are more players in the market like Robinhood and other companies which offers you fraction of the ETF unit. So you can literally go and buy $1 worth of ETF if you want to. That's pretty cheap, and you can start your investing journey with the ETFs. For mutual fund, it depends on what you are trying to invest in. It is usually between $1,000 to $3,000. For index fund, it is usually higher compared to ETFs and mutual fund. For example, VFIAX, VTSAX, the minimum investment amount is $3,000, which is pretty steep if you are just starting out on your financial journey. Let's talk about transparency. Since ETF is actively traded on the market, you are assigned the units right there during the active trading session. So it is extremely transparent. You will know the exact number of units you have been assigned and the price of that unit. For mutual fund and index funds, the units are assigned to you by end of the day as per the day's NAV. During 2008 crash or during COVID crash, when the market tanked significantly during the day, some people tried investing to benefit from that instant dip. But many mutual funds struggled to update their price or NAV timely, so the investor did not get the price they were expecting by end of the day. So relatively, mutual fund and index funds are relatively less transparent. So in conclusion, if you are a good trader, if you know how to benefit from volatility of the market, you understand the ebbs and flow of the market, and you consider yourself a good trader, then ETF is a way to go. Mutual fund, I would say it has higher expense ratio, so I personally wouldn't go with those. My way to go is index fund, the good old index fund for long-term growth. I have built my 7-figure portfolio just by dollar cost averaging in good index funds. Please don't forget to watch my first video about how I achieved financial independence and retired early at the age of 41. If you find any value in this video, please don't forget to subscribe, share, and like this video.